Our guest today is Mr. Pankaj Pandey, the research head of ICICI Direct, which is a trusted brand with which you can live the ant life. That is, meet your aspirations with research-backed investments. Warm welcome to you, Pankaj, and thank you so much for taking the time out for this uh, show. And of course, before we begin understanding from you the key stocks, sectors, themes that will be in focus, I want to take a broader understanding from you as far as the upcoming budget is concerned, and that is with regards to the economy. Will the budget 2024-2025 propel the economy on a sharp growth path right ahead?
So, hi, good afternoon. Thanks for having me. I think when we sort of dissect the overall template of the government in the past few years, I think one thing is quite clear is that there are certain major focus areas. So, for overall economy, I think the key focus area is to have lower inflation, higher growth. Inflation, luckily, has been good for us because globally we haven't seen crude doing much. Monsoon is expected to be good, so inflation is not a really big worry for us. I think 4.5 to 5% kind of a inflation is very much as an expectation and pretty normal also to have. Then I think last 3 4 years we are growing at 7% plus GDP kind of a growth rate, so that is there. And the last one is fiscal prudence. So I think overall, except for COVID period, fiscal prudence has been sort of maintained. And we would want to believe that this budget also is going to sort of be anchored around two, three parameters of these. While there is a concern that there could be some element of populism because unlike in the previous past, we have seen this government being a coalition government, though the coalition is strong. But I think the only factor which needs to be washed out is the element of populism which might be there in the budget. Otherwise, our sense is that this capex template, along with low inflation, high growth, and fiscal prudence, is going to be maintained. And which is why we believe that the current set of winners, sectors, and stocks, that is unlikely to change much. Obviously, not. We don't expect everything to sort of perform in a single linear line. So I think, which is why you will have periods of correction. But I think the overall bias towards capex-oriented themes or core sectors, including some of the energy transition themes, is very much intact.
Okay. Hello, Mr. Pandey, and a very warm welcome to you on Business Today Television. Shail Bhatnagar this side. I just wanted to understand the medium-term outlook on some stocks that ICICI Securities might feel may outperform for long-term holders. Any names that you can think of with the budget in the background and of course the high capex that's expected by everybody?
So while there could be a long list, but I think I can highlight some of the names. So for example, one thing is clear that there is a decent amount of focus on renewable energy. The BJP Sankalp Patra talks about energy independence by 2047. And we all know that PSU banks have been sort of doing well, but there is a limitation in terms of PSU banks or any private sector banks in terms of having an exposure towards a certain sector, and which is why I feel that specialized NBFCs have a role to play. IREDA has been one stock which we have been quite bullish on. The results were already out. So, for example, while recent quarter 34% kind of a AUM growth is what we have seen. And we would want to believe that this is one company which can keep on delivering 30% AUM kind of a growth, because if you are going from say 172 gigawatt to 500 gigawatt, you are looking at a massive opportunity in the range of 20-25 lakh crores. Part of it is expected to be contributed by IREDA. Similarly, I think our belief is that the entire cement as a pack, be it large caps or mid caps, are attractively placed. Now, we understand that last quarter or this particular quarter is expected to be weakish because companies are not really driving growth through pricing, but more through volume growth. So, which is why the big ones like say Ambuja Cement or ACC, or even tier two names like say for example Sagar Cement or Birla Corporation. I think these are the stocks which are sort of looking attractive to us. Infra is another space which we believe can do well. So while L&T is obviously the preferred pick and kind of a portfolio stock for most of the capex themes, I think NCC is another stock which we have been liking for quite some time. I think if somebody can't really look at an exposure towards L&T, then NCC is one of the few companies to be looked at. And then we are also sort of looking at specialized road players, also the likes of KNR or even PNC Infra, because our sense is that while the road infra has got its own share of attention, but I think expressways is something which probably might come up, and which is a high capex segment to be sort of looked at. So we are still sort of looking at almost a similar set of winners which have been there in the last 1 or 2 years.
Okay. Pankaj also wanted to understand about the key PSU sectors that have outperformed in the run up to the budget, defense and railways. Will they continue to find flavor even after the budget, or do you think despite announcements of higher allocation, promising schemes coming in for these particular sectors, the best is already at the price?
So for defense, yes, I mean, you look at any defense PSU name, it's trading in excess of 45 times on a forward basis. So not much really juice is left with whatever numbers we are working up with. So any kind of a consolidation and price correction is a welcome correction we would expect. But yes, we would not expect them to sort of keep performing the way they have sort of done so. Similarly, for railway also, a similar move has sort of panned out. So I think while railway is also a very longish opportunity, but our sense is that given the already decent run up what we have seen, probably some bit of a correction or consolidation is warranted, and that might provide a slightly better opportunity to sort of enter. But at the same time, when you look at some of the PSU banks, one, there has not been much of a price performance. They are in fact better placed compared to the private sector counterparts on CD ratio. They are well capitalized, and asset quality is really not a challenge for most of them. So we've been liking most of the names in PSUs. So be it State Bank of India or Bank of Baroda or something like Indian Bank.
Right. Pankaj, we'll also look at the broader theme. You've discussed what the budget is likely to do for PSUs, defense, housing. Within the infrastructure space, mostly we have all that we require in place, a fabulous road network. Airports seem to be done. Ports are getting expanded. So within the broader space of infrastructure, where do you see private capex coming up? In the sense that over the last 3.5 years, the government has done the heavy lifting. But what about corporate India? Where do you see fresh factories coming up? Which sector has more than 100% of capacity utilized and is now looking to expand brownfield or greenfield?
So I think when you sort of look at in terms of texture of capex, I think power is one sector which we feel that has a very long runway for growth, not only for this decade or even for a decade after. Largely because one, we are seeing multiple themes panning out. One, we are looking at energy transition from thermal to say renewable energy, which could be a combination of solar plus wind. Plus, there is a big hydrogen push what the government is looking at, and with power is very incremental or very pivotal in producing hydrogen, and which is where I think you see the maximum capex. So half of the capex is going towards the power sector, and we're liking most of the companies there. There's some companies, especially on the capital goods side, which are expensive, a bit difficult to justify, especially the MNCs. But when we sort of look at or when we speak to companies, our sense is that demand for some of the products like transformers, I think next 2-3 years, you really do not have capacities to sort of supply, and similarly for on the wind side. So, so I think you have pockets where the capacity is really in shortage, and which is why we feel that power as a theme is here to stay for a good period of time. And on top of it, what you're also looking to do is that there is energy transition happening in the auto side also. So power, I think, is one thing where we are liking the PSUs also and some of the private counterparts. But we really do not have a very big coverage across. So I think big ones, what we are liking is something like NTPC or in the, say for example, in the other domain, probably on the transmission and distribution side, some of the companies. But in general, power is one sector where we are seeing capex from both private players as well as PSUs.
Right. Pankaj, there is, a consensus across the board that much of the rally in the markets is in place, and except for large caps, most parts of the market appear overheated. You've mentioned some names in large caps such as NTPC that you prefer, but within this space, which is the lowest hanging fruit where you see continuous earnings growth and yet under appreciation by the market?
Very difficult question to sort of answer because I think when you look at India, I think we have got economic stability, we have got political stability, growth has been good. The only complaint with most of the people have with the Indian market is the valuations are rich. So be it large caps, mid caps, and small caps, you have pockets where the multiples are rich. And the richness in multiples is because of multiple reasons also. It's not that so one obviously is that the domestic liquidity is good. The other factor is that after a long period of time, there is a decent amount of comfort in terms of durability of growth rate, and which is why uh, you are looking at companies beyond 2 years. Otherwise, typically when you sort of build models, you look at a visibility of 2 years, and basis that you attempt to sort of decipher a particular target price for a company. But now you are able to sort of because there is a decent amount of comfort in terms of looking beyond 2 years also, which is why the multiples have gone up. Now, between large caps, mid caps, and small caps, I think again you have pockets where things are okay and things which are sort of rich. So, for example, within large caps, banks are relatively looking attractive. One, you could get a 14-15% kind of a growth rate. Asset quality is already pretty good. Valuations have not really been on a higher side. Similarly, in the mid cap and small cap, it's very stock specific. So, for example, to highlight, we have companies like say Philips Carbon Black, where we are comfortable with the kind of growth rate which company will deliver, and multiples are okay. So, I think within mid caps and small caps, it is a bit more challenging given the run up you have already seen. Mind you, for example, from June lows, we have seen nearly 23% kind of a rally in mid caps and 28% kind of a rally in small caps. It's a fairly large universe of 4,000 plus stocks. So that is where the challenge lies in terms of figuring out stocks where we have seen that kind of a run up, and also the story looks interesting. Similarly, if I have to highlight, CRAMS is one opportunity which is looking good to us. So Glenmark Life Sciences is also a company which is looking attractive to us. So you'll have to probably do a lot of figuring out in terms of which stocks will do well.
Okay. Pankaj, let's also look at some other sectors which are probably hopeful of some focus in the budget tomorrow. The tourism and the hospitality sector. A lot of interesting names buzzing today. Indian hotels is up by 7.2%, and the entire space seems to be buzz with all the action. When we look at ITDC, several other stocks within the hotel space. Royal Orchid was moving in the morning. Tourism Finance Corporation is abuzz with about 3% higher moves coming in. Indian hotels, we have the other stocks also. How are you looking at this entire tourism hospitality theme, and do you think investors can continue to benefit if they invest here?
So when you sort of look at the entire these set of companies which you spoke about, I think Indian Hotels is somewhere about 80,000 crore kind of a market cap. So probably the only company which is there in the mid cap domain. Most of them are sort of small caps. So if you have to play that hospitality theme, you'll have to largely look at these smaller cap themes. Now the challenge when you sort of look at from these is one that there has been a decent amount of price performance. but we are still liking this space largely because I think this is one of the few pockets which are going to benefit or which will keep benefiting from the trend of premiumization. So one is obviously the auto stocks. I mean, you look at standard features like alloy wheels or panoramic sunroof are becoming standard features. Similarly, one or twice holiday or two times holiday in a year is a bit sort of a becoming of a norm. And I think the kind of room rates, if you sort of look at, has seen quite a jump, and that is across segment. I mean, be it for lemon tree, be it for Indian hotels. And this is here to stay for some period of time. I think we are liking the entire set of themes where premiumization is at play, including this one. There could be some pockets of correction. And I think from the budget perspective, our sense would be that, see, the government is talking of making airports into regional transportation hubs. Plus, there is an expectation of being more focused on the tourism side. Any kind of a development there obviously will have a lot of these companies and sort of developing this sector, because this sector is quite important from an employment generation perspective, unlike a lot of other sectors where the mechanization does more of a job rather than human labor. So here, more human labor is required. So I would want to believe that this would be one of the focus areas of the government.
Right. What we'll do is just take a detour into the market, Sakshi. At the moment, there are about 1370 stocks in the green compared with 950 that are in the red. Major indices, the Sensex Nifty and the Bank Nifty are, just flat, doing nothing at all. The Nifty at 24,500 is down 30 points. Where is the action? The action is in mid-cap select. The index itself is up 2.5%, and you have a strong flow coming into mid-caps such as Indian hotels, which we've discussed. IDFC First Bank up 2.34% at 77.80. A lot of accumulation, ladies and gentlemen, is happening in Container Corporation. Remember, the government has put its divestment plans on the back foot as far as this railway giant is concerned. Persistent up 4%, 4,765. Lupin is 30 rupees higher at 1816, and you have a strong move coming into. Would you want me to mark MRF, Sakshi? 1,31,309. This is a common joke between us. Digit bhi fit nahi hote kabhi kabhi to. And of course, AU Bank 3.6% higher, 650, 650. So the action, whether we like it or not, ladies and gentlemen, is concentrated on mid caps. Pankaj just a moment ago mentioned the kind of overvaluations that you are seeing in this space, but the rally is unceasing. 2 or 3 days of dip, intraday dips, and those dips are purchased, and those same stocks move up higher and higher. Pankaj, again, consensus view that railway will do well. Over the last 3 years, we've seen capital allocation increase consistently. Any themes which you feel are yet to be fully explored within railway? What are your plus points there?
So one is, if you look at the sheer amount of capex which is going to happen in the railways is enormous. I think it's $750 odd billion kind of a capex is what is being talked of on a longer term. Because what you're trying to do is that you are going to move 28% of the freight share of the railways to 45%, and that will require a massive amount of capex. And then it's not only that we will have Mumbai Ahmedabad bullet train. I think what is being talked about is that possibly we might have these trains on other routes as well. Especially on the north side or in the south side. You will have a lot more opportunities which might come up. We are looking at some of the companies, not that we are we have a view on these companies, but so for example, we are positively inclined towards some of the companies like say Aircon, because besides L&T, this is one of the few companies which is eligible for participation in the high-speed train. So from that perspective, again, it's a very selective kind of opportunity we would sort of look at. And like I said, IREDA is again a sort of a very broad-based theme across all this. I mean, be it hydrogen, be it renewable energy, be it a lot of these themes which are going to come up. But it's not that we are structurally negative. It is just that some of these themes have run up, so which is where we would expect them to sort of consolidate for a period of time, unless something surprises big time in the budget. Because see, railway and roads have been getting 50% of the overall capex allocation,
Yes.
and these allocations have gone up 5x in the last 4 5 years. So railway used to get an allocation of somewhere about 50,000 odd crores. Now that has moved beyond 2.5 lakh crores. And with the kind of capex what the government is talking, we would want to believe that that intensity is going to be maintained.
Pankaj, also wanted to understand with respect to the entire consumption theme that everybody is focused on in the upcoming budget, rural focus, where do you think investors can keep their attention in? Should one really look at the irrigation related stocks? Should one look at staples or FMCG with that respect, or should one look at probably sugar related stocks where probably there could be announcements on ethanol blending? There is a hope that the PM Kisan scheme may get some extension and some hike right there. What is the best way to play the rural consumption theme?
So from a budget perspective, what looks believable is that this PM Kisan Yojana, where we are transferring about 6,000 odd rupees on an annual basis to about 11 crore farmers, that might get revised to somewhere about 7,500. Now, to sort of play something of this kind or other kind of a measure, I really do not subscribe to the fact that FMCGs or staples are one of the better bets. I think if I have to play that theme on the consumption side, I find the autos or two wheelers as a sort of a better opportunity, because what we have seen in the last 3 4 years is that the average selling price even in two wheelers has sort of gone up by 50 odd percent. So I think if somebody has more money, they would like to sort of upgrade themselves here. Similarly, I think consumer durable looks a lot more better across the value chain. So that is another. And I think one way to sort of play this also is the hospitals also, because hospital, while it is a sort of a forced consumption, but we believe that if things become better, I think rural area we've seen a lot of segments or a lot of households sort of ignore health, and possibly better health access is going to be a lot more helpful, and that is where we would expect more of a secular growth to sort of pan out.
Right. Pankaj, thank you so much for your time, and we hope to interact with you a lot closely tomorrow, which is the
Thank you very
D-Day
much.
as far as markets are concerned. Have a wonderful evening, and we look forward to you joining us tomorrow again.